Good morning, everyone. I am Mallory Vachon. As Dan mentioned, I am the chief economist at a company called Labor IQ. So what we do is we do compensation software. We work very closely with a lot of HR and recruiting leaders, providing them with compensation benchmarks and salary forecasts for hiring in today's market. We all know things have been crazy over the last couple of years. So I also wanted today to present some challenges and opportunities that are facing HR and recruiting right now. And I do think that there are some opportunities, at least some silver linings coming through. So I am on our product team, I lead our data team, and I also get to speak with folks like yourselves and SHRM and different national media about what is going on in the labor market and what that means for businesses today. So that's a little bit about what I do at Labor IQ. Feel free to connect with me on LinkedIn. I also write our company's newsletter where we talk a lot about what's going on in the labor market, as well as sort of like actionable pieces and tactical advice for HR folks. Recently, I did a post or an article about how to write a great job description so that candidates can understand what that means for them, as opposed to just a general, so many things that you see could easily have been written by ChatGPT, unfortunately. So what do we do? So I mentioned salary benchmarking, compensation benchmarking. So really what sets us apart is our recommended salary. So not only do we tell you what people are making in the market through our median salary and our bell curve, but we tell you what, based on our forecasting, proprietary data science, what you should actually be paying to attract and retain talent in today's market. We provide salary forecasts to help you understand your budget for merit planning. And then we also provide salary ranges that you can use for pay equity, pay transparency, and just setting your internal pay bands. Let's move into, so that's a little bit about me, my company, what is going on in the labor market and how does that relate to recruiters? So I'm hoping to give everyone here an overview of not only what's happening currently in the labor market, but insights that you can take into your interviews or even your own LinkedIn posts to really come across as thought leaders about what's happening so that you are, in the driver's seat. So it's been a really interesting and challenging labor market where we've been. The labor market is definitely starting to cool down, but the key has been a lot of resilience. So last year, in the expectations going into 2023, where we would have 60 million hires, 1.2 million net job gains, so net new jobs created, end the year with an unemployment rate around 4.5%. So that kind of puts us right around historical averages, and then about 25 million total layoffs. And all of those, we ended the year on the upside, but that doesn't mean that it feels exactly that way for everyone. And here's why. So you probably heard the term on LinkedIn and the news, a soft landing. And by all metrics, the labor market, as we just saw, has exceeded expectations and is overperforming and really strong. Unfortunately, by industry or location, it might not feel that way. And when we take a step back and look at, the last 20 years or 10 years, back to 2014, we were averaging around 2 to 3 million, 12 job gains in every 12 months. And that's pretty solid. Once we hit the pandemic, we saw immediately a giant loss of jobs, but that returned relatively quickly. And HR and recruiters were the ones who were tasked with hiring those 14 million people that we did to kick off 2021. And you were also in charge of figuring out how to orchestrate remote work, distributed teams, how do you keep up with pay demands that are increasing, great resignation. So when you look at this slope down from around 2021 to where we are today, our current numbers are still relatively strong and above where we were. But if you've gone from making that 14 million hires to now making 4 million hires, it might not feel like a soft landing for some of the sectors that have been involved. And I think HR is one of those groups that has really been tasked with, the big stuff. And then as hiring started to slow and as the labor market started to soften, you started these folks and you folks were the ones who were impacted negatively because companies that didn't have a need to hire anymore. So it really hasn't felt like a soft landing for HR. And I think that also, gets into industries as well. So I'll cover a couple of things today. I'll talk about industries and I'll talk about compensation trends for 2024. I've also included at the end of my slide deck that I'll have fan circulate to everyone some stuff about the talent shortage that we're facing right now. I think that can be really useful as you're interviewing for jobs and or even just posting on LinkedIn or however else, to really come across as a thought leader about what's going on in the labor market and how you can best position yourself as a leader in your next role or next company. So industries really matter, and we talked about HR has been feeling it, but there are certain industries that are just not feeling it as well. Not everyone is moving at the same pace as the national benchmarks. So overall, we've seen broad headline growth in the economy. A broad range of industries have added jobs over the last 12 months, which is really great. Only information, so that includes your entertainment jobs, which were faced with strikes last year, as well as technology roles, lost jobs over the last 12 months. So overall, I said these headline numbers are looking fairly strong. There's a couple of challenges though. So only 3 industries accounted for 2/3 of all of the jobs added in the last 12 months. So if you're serving government, healthcare, leisure, and hospitality, that is probably looking good for you. However, a lot of other industries are not really matching our average national pace of growth. So professional and business services, which also includes temporary staffing and employment, has really struggled. That's actually been one of the industries that has been hit the hardest over the last couple of years as we've seen hiring slow down. So I'll get through here a scatter plot. So this is one of my favorite charts to show because I really think it helps identify why not everyone is feeling this strong labor market that we have overall. So from left to right, that's going to be what the annual rate of hiring would be, or job growth would be, if we kept adding jobs at the pace that we have over the last 6 months. And then top to bottom is going to be the job growth over the last 12 months. So you can see nationally, we've had 1.8% job growth year over year and around 1.5% over the last 6 months. But when you look across industries, so those gray dots on this chart, there's a wide range. So where you really want to be, you want your industry to be, is in the top right quadrant. That's sustained job growth. Trending positive means you've looked better over the last 6 months than you did over the last year. Trending negative means you're kind of heading in the wrong direction. You're negative in the last 6 months, but positive still year over year. And where you really don't want to be in the sustained job losses category. So one thing that you'll notice is that almost, we're split in half. Either industries are doing really well in sustained job growth quadrant in the top right, or sustained job losses in the bottom. There's not a whole lot in between, which explains some of the differences we're seeing and feeling in the labor market today. So what industries are these? So leisure and hospitality, information have all done really well. As I mentioned before, information, motion picture, and sound recording has benefited from the fact that those strikes are over and has really seen a lot of positive momentum since that ended. Another information category, so sector, web search portals, so your internet companies, your technology companies are starting to head in the right direction following a rough 18 months or so for the tech industry. Now, where we see some challenges, so financial activities, credit intermediation, with interest rates rising, not a lot of long-term financing going on. Textile products, as people are, no longer buying houses. The housing market's kind of locked up a little bit right now. That's been really tough. I was at a conference a couple of weeks ago with our local Dallas SHRM chapter, and one woman there is really struggling with hiring right now and just figuring out how to move her organization forward. And she focuses on manufacturing luxury outdoor furniture. So if people aren't moving, people aren't buying new houses, that's going to be an industry she's been having a big challenge right now. So finally, as I mentioned before, government, leisure, and hospitality and healthcare accounted for 2/3 of all jobs. All of those are in that upper right quadrant. So folks that are looking for some stability or maybe need to tweak their industry that they're currently in, those are areas where, especially government and healthcare, where there may be more opportunities right now. So as we think about industries, what are some short-term and long-term trends that I'm watching as I want to understand what's going on in the labor market and really translate that? So in the short term, this is an item that we've kind of added and taken away from our slides overall, but government shutdown kind of keeps being in the news. And while luckily we've avoided one so far, if that does happen, that could really hamper, at least in the short term, some of our government jobs that we've been adding. And then in the long term, so the Bureau of Labor Statistics, which releases all of the economic and labor market stats that I look at on a daily, weekly basis, they put out a 10-year forecast saying that healthcare will drive job growth going forward in the next 10 years. I think it will account for about 50% of jobs added over the next 10 years. And home health aides will be the single, hottest job added. So you're looking to switch sectors, healthcare, certainly, especially as our population ages, is going to be in high demand. So moving on a little bit. So we've talked a little bit about industries. Let's move on to compensation, where my company focuses on in our bread and butter. While the labor market is softening, I think one caveat that I've been really delivering in all of my presentations over the last 6 months is that we don't really see a shift back to wage growth expectations that we saw before the pandemic, because we are still in a talent shortage. Even though it's really hard for a lot of folks to find work, we're still in a talent shortage, and we're still seeing turnover at an elevated rate, voluntary turnover at an elevated rate. We're going to see compensation demands continue to be a little bit higher than what we would have seen before the pandemic, and we don't expect that to kind of shift back. So one metric that I've been tracking is the Atlanta Federal Reserve Bank puts out job switchers and job stayers. And you can see during the Great Resignation, people that switched jobs were getting large pay increases, a magnitude of 10%. I'm sure folks here placed candidates that saw even larger increases. And I have friends and family and have worked with clients that have seen the same thing. Job stayers have seen a little bit more modest increases. And we now are seeing that delta start to close. So good news is that retention issues should start to subside for businesses. The challenge is, as this gap remains between job switchers and stayers, there's that focus on equity that will be at the forefront. So when we go back, so let's take a little bit of a step back. What did this look like in 2022? We were seeing massive increases for people, and in some ways, what we would consider outlier pay. So people were getting jobs or getting salaries that couldn't even necessarily be forecasted. It was just, especially tech companies were offering massive pay increases to folks that you really couldn't turn down. It was like life-changing pay. And what we saw, because I work with a lot of small and medium-sized business clients, is that they were just completely being outbid, and to where their budgets could absolutely not sustain the prices that, or the wages that were being offered. What we're starting to see now, and this might be familiar for folks that are in a job search, is much more modest pay increases, and even some backsliding for those folks who maybe were part of the big round of hiring that tech companies faced, and then also, or not just tech companies, but overall, I think this was really prevalent in tech. Even some backsliding, maybe where you're not seeing offers that are at the rate that you were, because of the labor market is starting to soften quite a bit. So what do we expect for 2024? So as we look back before the pandemic, wage growth was averaging right around 2.5% to 3%. I think you saw the number 2% was a pretty common increase for annual merit pay. What we're expecting throughout 2020, 2021, 2022, we were much closer to 5%. 2024, our current forecast is 3.5%. So I will be watching this jobs report on Friday to see where that is. I would not be surprised if we end 2024, continue to revise our forecast up a little bit, closer to 4% end the year, just because of where the market has gone. So I'm here wrapping up with 2024 expectations and some numbers that I'll be watching. So when every quarter the Wall Street Journal puts out a forecast, and we try to update our forecasts monthly, if not quarterly, we were expecting around, so our forecast was 1.4 million job gains. The Wall Street Journal's kind of average was around 800,000 new jobs added throughout 2024. We have already hit around 600,000 jobs added in the first 3 months of the year so far. So what we're looking for, so we've already kind of blown past some of those expectations, as long as we don't hit a recession, which we aren't really forecasting. So even at the beginning of the year, about 40% of the Wall Street Journal's economists were projecting a recession. That number has been going down basically with every single positive jobs report that we've had. Couple of numbers to also watch are the annual wage growth figures. So if we see that number again around 4%, that's a signal that prices are probably growing a bit too high. The Fed's still watching inflation. We're not going to see those interest rates coming down a bit more. The other piece is voluntary turnover, which is going to contribute to wage growth. So 2023 defied expectations, but 2024 is heading that way as well, but expect we're on the path to normalization this year.